On today's Hot Sheet, I'm discussing down payment trends, household debt, mortgage applications, and the April CPI report. Today is Wednesday, May 15th, 2024. I am Byron Lazine, and the Hot Sheet starts now. Welcome into the Hot Sheet on this CPI day. I am smiling. I know it's hard for me to get a smile going with this face, but I am smiling today. CPI came in, and I've got to say, I'm pleased with it. The 10-year is reacting favorably. We'll save it to the very end. It's that good. Save the best for last. So we will do that. Let's start with some down payment data, down payment trends reported from Realtor.com. The average down payment in Q1 2024 came in at 13.6%, which is down from 14.7%. I keep looking for these signals that the consumer is softening up a little bit. We keep talking about how great this economy is and all of that. And anecdotally, I don't see an economy that's great for everyone. And there's a lot of data points that we keep pointing towards that indicate that. The average down payment being down from Q3 in 2023 obviously showcases that, one, there's an affordability thing, so people are bringing less to the table, and prices are higher. But I think also that people have a little bit less wiggle room. The median down payment in Q1 2024 was $26,000, which is a decrease from the $30,400 in Q3 of 2023. So both sale amounts and down payments remain higher, though, than pre-pandemic levels. Okay, so good news there. In Q1 2020, the average national down payment was 10.7%, and the median was $14,000. So quite a difference there when we look at Q1 to now. Really, that percentage, I think, stands out to me, 10.7% versus today at 13.6%. The dollar amounts are going to be certainly higher when you take 13.6% of a higher price point today. The national average down payment for primary residence is 11.7% with a median of 19.7%. Here are the states directly out of your BAM-X show notes. With the largest down payments, New Hampshire from 17.5% in Q1 to 20.9%. So these are all up. Rhode Island is up 14.4 to 16.7. Connecticut 13.9 to 15.7. New Jersey 16.3 to 18. And Washington 15.5 to 17.2. 1 through 4 all have low inventory in common. So when you're in a competitive environment like that, of course, the seller wants to see more skin in the game, more of a down payment. There's probably more cash offers winning out in those markets as well. Here are the states where down payments declined. Montana, down. Washington, D.C., Wyoming, Oklahoma, South Carolina, Utah, Florida, barely down on once we get to 4 here at Oklahoma, it's barely ticking down. Delaware, Texas, and North Dakota. All right. We've got a Now BAM article that is breaking all of this down for you. There's also some slides inside of your BAM-X show notes if you're interested in that. This shows over time here from 2013, primary residence average down payment and median down payment dollars. So while on the decline right now, there's obviously a huge impact on interest rate with that, but substantially higher from any point from 2013 to 2020. So another indicator that the overall home buyer, while those that are in the market right now are feeling the economy and the pressure of that, the inflation, the interest rate, these types of things, they are still a very strong buyer looking back on the past, okay, or they wouldn't be able to qualify at these numbers. So there's your down payment trends and reports from Realtor.com. There's some more information there. You can dig into the nowbam.com article, as well as hit all of the show notes inside of your BAM-X Hot Sheet show notes. All right, taking a look now at what's up next here is household debt. This has been a big discussion. You'll see this a lot in headlines. Quarter 124, household debt rose by 184 billion to 17.4 or 17.69 trillion. So quarter one, 184 billion. Now household debt at $17.69 trillion. Significant increases in mortgage and HELOC balances, while credit card and other consumer loan balances actually declined slightly. Overall delinquency rates edged up to 3.2%. Household debt balances increased by 184 billion from quarter four, so 1.1%. So the 184 billion is the number that came in, and it increased 1.1% quarter over quarter. Balances now again at 17 plus trillion, almost over 17.5 trillion. Pandemic comparison. There's been an increase of 3.5 trillion in debt since the end of 2019, which is interesting. When we came into the pandemic, say end of 2021, the common theme was people are paying down debt. Credit cards there's not a lot of debt on credit cards. Okay. And that you hear that every single month. So to increase 3.5 trillion since 2019, a lot of that has come in 22, 23, and here in 24. Mortgage balances increased by 190 billion. The total is at 12.44 trillion at the end of March 2024 on mortgages. Now, prices also, home values have gone up considerably. That's going to push that total mortgage amount up quite a bit. Auto loan balances increased by 9 billion. That totals 1.62 trillion. Credit card balances decreased by 14 billion in quarter one, but are 13.1% above the level a year ago. All right. So that number means something. 13.1% above a year ago on credit card balances, totaling 1.12 trillion outstanding on credit cards. We are living, I think it's 60, basically 2/3 of people live paycheck to paycheck right now. So we are living in a time where if these rates stay higher for longer, which is, still the consensus out there, we're going to start to pinch that homeowner. In places like the Sun Belt, where you got an inventory going up, it might become more difficult to move the property quickly, right? The argument a year and a half ago was, well, I could just move the property within a month and a half, 4 weeks. That's not the way for everybody, for every market right now. So people got to be careful if they're riding the edge on debt. Mortgages, 3% originated to borrowers with credit scores under 620. So the silver lining here is they're not handing mortgage. This debt's not being accumulated with credit scores under 620. It's just not happening. Auto loans, though, 16% originated to borrowers with credit scores under 620. I don't think that's uncommon from history, though. Median credit score is flat at 770 for mortgages. Okay, the median credit score to get a mortgage is 770. Increased to 724 for auto loans, which is the highest on record. Okay, so credit scores are coming in really strong, median credit scores for both mortgages and for auto loans. New mortgage debt, the 403 billion in newly originated mortgage debt and foreclosures, 44,000 individuals had new foreclosure notations, slightly more than the previous quarter. We went through serious delinquencies yesterday, which is not a concern at all. Outstanding debt for student loans is at 1.6 trillion. That's a bigger strangle on the economy than anything, because of the utility of the degree. Doesn't meet a lot of times what was invested into it. Okay. So there you go on the household debt. There's a whole bunch of other information there to dig into. If you'd like to, it's all available inside of your BAMX show notes. Mortgage application. Here's a big one. Then we're going to get into CPI. Mortgage application data. We look at this every single week, and mortgage applications are going to show an increased top line number from 0.5% 1 week earlier, according to Mortgage Banker Association. But that's not the true story, unfortunately. And I think I just saw Jody in the comments talking about some of the lenders are doing more refis. So the refi increased 5% from the previous week. It was 7% higher than the same week 1 year ago. To me, that's another indicator. When rates are this high, that's another indicator that not every consumer is doing great. If you got to go refi in this market, you need the money. You need the money for something. The seasonally adjusted purchase index decreased 2% from 1 week earlier. That's the number we care about. People going out and getting purchase loans. That's down 2% from last week. And it's also down 14% than the same week 1 year ago. The argument that we're going to get, really anywhere off of the floor right now seems to be slipping away as this spring market is wrapping up in most markets across America. The argument of over 4 million seasonally adjusted existing home sales that seems to be losing its steam. 14% lower than the same week 1 year ago on the purchase index. Now, we're not seeing those sales drop, but we are seeing them sit at this floor. Laura says, why would people refi at these rates? Here's the point. This is an underlying indicator that the job data that we're being fed, this economy data that we're being fed is not as strong. And so if people are going out and refining now, and the argument might be, why wouldn't they sell? Well, because they might not want to become a rent. They know that if they were to sell, they're going to become a renter, as opposed to refining, getting the money that they need, and keeping the house. If you sell, and you're at, say, even 4%, you're not gonna. If you need money, you're not gonna be able to go out now and buy at 7%, right? So I think that's why a lot of people are, not a lot of people. These numbers are just up. These aren't huge numbers. I mean, the refi business is ticking up. I do know what Jody's talking about. You talk to a lender, like, yeah, interestingly, I'm getting calls for refis right now, which, they went away for almost 2 years, right? They were almost non-existent for quite some time. All right, consumer price index. Here's the juicy stuff. Here's the stuff we've been waiting for. We get this report once a month, and the consumer price index increased 0.3% for April, looking backwards on a seasonally adjusted basis. This is after rising 0.4% in March. The reason I was smiling to start the show is this met expectations. For the first time, and it seems like in a couple of readings here, we don't have a inflation report saying that it was above expectations. U.S. inflation eased in April from March, with a key measure of price pressures slowing to its lowest level since spring 2021. The CPI for goods and services across the U.S. economy rose 3.4% in April from a year ago. So we're at 3.4 overall, according to the Labor Department. And the core prices that exclude volatile food and energy items did climb to 3.6 annually, which is also the lowest since April 2021. Both of these year-over-year results were in line with expectations from economists polled by the Wall Street Journal. So really great news. But let's take a look deeper into the report, as we always do, on where we are at with shelter. Okay, did shelter move down? What does owner's equivalent rent say in the report? This report breaks down everything. We always link up the full report inside of BAMX so that you can grab it. But I mean, it'll go to eggs and videos and everything. So here we go. Here we're at with shelter. Owner's equivalent rent of residences, which is a made up survey. It's been going on since the 80s. That's 26.64% weighted on a scale of 100 of what makes up CPI. So shelter overall is over a third. It's at 36 plus percent weighted. And here we go. Let's take a look for this past month on shelter. 0.4 in line with last month. Shelter year over year at 5.5. So overall CPI coming in at 3.4. Shelter is at 5.5, so higher. Rent of shelter coming in at 0.4 versus 0.5 last month. And lodging away from home coming in at negative 0.2 after being 0.1. There's not much weight in lodging away from home, so not that big of a deal. Owner's equivalent, though, rent again at 5.8. So that's still a number being weighted at 26%. Owner's equivalent rent 5.8 year over year. That number still has got to come down. That's driving a lot of this CPI data. You've heard my thoughts on owner's equivalent rent of residence, and it's just not, to me, it's not a great data point, but yet it's weighted so heavily in this report, a quarter of it, and it's sitting at 5.8. So that's going to inflate these numbers. When we do get good readings, and when we get maybe some of these CPI readings that reflect current rental data, we're going to see more of this. We're going to see a 10-year that takes a drop. We're now down to 4.377. If we just look at the last month, here we go. We're on a downward trend all of a sudden from 4.7 now down to 4.377 on the 10-year Treasury yield. It's going to mean good news for the 30-year fixed rate today. Could we start talking about Walmart 7% interest rates? That's 6.99 again. I think we could. I think you probably have a lender in your market could help get some folks a 6 handle leading the front. We're at 7.11 yesterday to end the day. And the Mortgage News daily survey today could certainly come in under 6 or under 7 rather, with where the 10-year is. So that was great news to see that this morning. Also great news is today at 3 o'clock, myself and Brian Boero from 1000 Watt are going to be hosting a free BAM webinar on the lifetime opportunity that is right now with building your brand. I see a lot of mistakes right now in the market of people not really thinking about their brand. A lot of mistakes of, public content that might be hurtful to some agents, specifically in this time. People are always watching. Remember that line. I think it was Jordan Cohen shared it with us. Like, people are always watching no matter what. They might not be ready for 2 years. Might not be Jordan. Might have been somebody else. But it's whoever deserves the credit. I'm crediting you. All right. People are always watching, whether you're 2 years out, 3 years out. They're always watching. They'll make a decision. They're going to consume your, content, whether they're throwing a like or a comment. And when they're ready to make a decision, all of the stuff that you put out, the way your brand speaks to the market is going to impact whether they even consider having a conversation in 2 years. Okay. Just because they're in their database not responding to your emails doesn't mean they're not a year, 2 years out from making a decision and doing something. It's just a matter of, are you speaking a language that resonates with them? And there's a lot of mistakes out there. We're going to uncover some of those mistakes and then dig into this big opportunity, probably the biggest opportunity of all of our careers right now when it comes to brand building. The link is down below for the free webinar today at 3 o'clock. Myself, Brian Boero and 1000 Watt. They've worked on brands like Picasso, Zillow, and Curator and others, and some of the biggest brands, maybe even the brokerages that you know and love. So that'll be today at 3 o'clock. Hope to see you guys over there. Until then, of course, toodaloo.